Hello, I am one of your guest lecturers. In this module, we will focus on the government and not-for-profit environment. Emphasis will be placed on the fund, accounting, and the content of the financial statements of these entities. To successfully understand a financial statement used by the government and not-for-profit organization, you first need to understand the purpose and elements of the financial statements. The Governmental Accounting Standards Board defines 7 key elements that comprise the basic financial statements, 5 relating to financial positions and 2 relating to resource flows. Do you recognize some of these elements? Certainly the assets and liabilities are categories. However, you likely may not be that familiar with the other elements. Net position is the residuals of a statement of financial position. As you can see, the net position utilizes the 2 key elements relating to the flow of resources to distinguish assets from deferred outflows and to distinguish liabilities from deferred inflows. Basically, what we are doing is reclassifying assets into deferred outflows and reclassifying liabilities into inflows. Deferred inflows of resources illustration would be if we imagine that your city receives property taxes in the year before they are due. This property tax inflow would be classified as a deferred inflow of resources. Deferred outflows of resources. This would be evident when grants are paid in advance or if the government gives cash to an entity to provide services in the future year. In your assignments and when reading your city's financial statements, do not confuse the deferred inflows or deferred outflows with inflows of resources, such as revenues, or expenses, which are outflows of resources. This brings up another important distinction, the difference between net position and the fund balance. Some challenges that you will encounter will be when to identify what basis of accounting will be used and which fund to use when recording a transaction. We will use a real-world scenario later to help you with these challenges. What about financial statements that are prepared on a full accrual basis? Let's see. The City of Houston operates airports, and the airports operate like a normal for-profit business under a proprietary fund. Therefore, the full accrual basis will be used, and the residual amount is referred to as the net position. However, in the statements that are prepared on a modified accrual basis, the residual amount is referred to as the fund balance. For instance, your government's major capital projects, such as bridges and buildings, may be financed with proceeds from revenue bonds. The capital projects funds will be accounted for on the modified accrual basis. Now, the modified accrual method differs from the full accrual you used in your previous financial courses. In the modified accrual method, revenues are recognized when measurable and available, and expenditures are recorded when incurred. So what is a fund balance and what is the purpose of fund reporting in the financial statement? Government and not-for-profit entities use fund accounting to demonstrate accountability. By segregating the assets, entities are able to demonstrate clearly that the assets were used for the intended purposes. By segregating certain activities, governments can better control the revenues and expenditures and expenses of these activities. It would not be uncommon for governments and not-for-profit entities to segregate assets whose use is restricted by outside donors. Nor would it be uncommon for these entities to segregate the revenues and expenses of activities that are supposed to be self-supporting. A case in point would be your Coliseum parking lot revenues. This leads us into another dissimilarity. We need to note when we read a financial report of a not-for-profit entity, such as a charitable organization or a not-for-profit hospital. Unlike governments, such as the City of Austin, not-for-profits need not present separate data of each of its major funds or fund types. For example, the net assets are classified into 3 groups based on donors' restrictions. What about government fund types? Governments normally maintain 5 types of governmental funds to account for its operating and financing activities. Governments also maintain 2 types of proprietary funds to account for its business type activities. And finally, governments maintain 2 fiduciary funds to account for resources held for the benefit of parties outside of the government entity. Think about your city that maintains these 9 funds, and we have data on some of these funds. Let's see how your city would classify several of its city's transactions. First, your city collects taxes. This would be accounted for in the agency fund. Your city spends on street maintenance. This would be accounted for in the special revenue fund. Your city receives a bequest, trust fund. Your city collects fees, enterprise fund. Your city builds a new bridge, capital projects fund. Your city invests on behalf of the county, investment trust. The city pays wages, general fund. And finally, your city pays debt service costs, debt service fund. As a helpful tip, when classifying activities into funds, determine the activity's purpose and the intent. In summary, financial reporting should provide useful information to its users in order for them to assess accomplishments and the fiscal health of the governmental entity. To enhance your understanding of this information, download and review the comprehensive annual financial report for the City of Austin and pay particular attention to the 7 key elements of its financial statement.